Hello and welcome to the DIY Investing YouTube channel. We're working through every company in the S&P 500, and today is Everest Re Group, ticker RE. This company is in the insurance industry, has a market cap of $12.9 billion and an enterprise value of $12 billion. So you see about $1 billion in net cash on the business. It's always nice when you can see a business in net cash. It tends to be a good sign. They provide reinsurance and insurance products in the United States, Bermuda, and internationally. This RE in reinsurance is what their name is for. Company operates through the reinsurance operations, has property and casualty, specialty lines of business. They work through brokers. That's a key point. And they directly have ceding companies in U.S., Bermuda, Ireland, Canada, Singapore, Switzerland, UK. You can also see that they have some segments in overseas as well: Canada, Chile, United Kingdom, Ireland, Netherlands. And they operate in various specialty services: marine, aviation, surety, errors and omissions, directors, officers, liabilities, medical malpractice, mortgage reinsurance, etc. So quite a broad range of insurance lines. Now, first thing that I noticed in this return on equity is that, this is extreme cyclicality in terms of what the results are from a year to year. You're seeing basically many years in the 10% range, 1, 2, 3, and then a loss. 1, 2, then a loss. 1, 2, then a loss. 1, 2, 3, 4, 5, 6. They didn't lose money in 2018. It's gotten a little better since 2012, but you can see the history. They have these big downdrafts. Of course, it's an insurance company, so as you report those losses, that's going to hit the bottom line, and it seems like they have some exposure to some very big losses. Now, if my understanding of the reinsurance market is correct, that's not abnormal. You're going to have that sort of exposure, but it is a problem for long-term shareholders when you're trying to make predictions about the overall predictability of the business. Especially when you look at these 10-year median returns, you see return on investment 2.7%, return on equity of 12.8%, return on assets 4%. Now, when we look at this return on equity number, right, so we want this to be of the 10% line. Well, we see 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14 years of the last 20 years above that 10% line. That's good, but not great. You'd like it to be 18 plus. They have 1, 2, 3, 4, 5 really bad years here where you're getting these 5% or below, 6 if you can include 2017. That's a lot of cycles. It makes it very hard to predict the long-term performance of the business. Now, it is insurance, so what you're trying to do with insurance is you take a lot of small risks over time and they even out and become a lot more predictable when you do that. Now, the problem is you really need to understand the industry, but reinsurance is pretty specialty insurance, and so it involves taking some very significant risks that other companies aren't willing to take on and then trying to make the premiums match up with that. One thing you can see is your revenue growing in line with premiums, 9%, assets growing 7%. So you're growing pretty quickly for an insurance company overall. I mean, you can see the revenue going from 4.9 billion to 11.3 billion, matching up pretty well with your earned premiums growth. But what I don't like about this so far is that it's unpredictable. That would be what I'd say. I like that I'm hitting this 12% number return on equity. I'd like it to be a little higher, about 15%, but it's in the ballpark of where you'd want to be. What I don't like is, of course, this return on investment number, 2.7%. A big part of the insurance business is the investment side of the business. And the problem for a lot of insurance businesses recently is that they're very bond heavy and interest rates have been low. When you look at that bond heavy, interest rates low, you get something like this return on investment, 2.7%. That makes it hard for investors to get a high long-term return because your bonds just simply aren't pulling enough weight. If you're in a company like Berkshire Hathaway where you're investing in equities, this can be covered pretty easily. But when you're most insurance companies, 90% plus insurance companies, they don't have much equity exposure, if at all. And so your bond returns are going to be a drag on the overall shareholder base for you as a shareholder, or overall shareholder returns. And so you can see that playing through here. Pretty good EPS. You get $15 a share to $34 a share. You're doubling, 7% growth. The problem is, so we look $34 to this $325. So it's not a bad price. Well, you'd have to rely on that 34 number, and that looks pretty abnormally high. So, I mean, if you can sustain 2021 numbers, that looks good. But, I mean, look, you're at a peak here of 13%. And, of course, the way that these have been peaking out, you would expect a downturn soon. So it's just hard to rely on. You're probably much more accurate using something like a 20 or 15, which would put that PE in the 20 range, 2024. I think that's reasonable, but I think that price is just a little high. So the problem you have here is you have relatively high price and pretty unpredictable. It's hard to know year to year what you're going to expect. You probably need to be an expert on the insurance industry for a company like this. Now, we're going to dive a little bit deeper into income statement, balance sheet, but before we do, hit that like button. Don't forget to subscribe. That's a great way to support the channel. So, income statement. Here you can see what I'm talking about. Net investment income actually turns negative for the last 4 years, 2018, 2021. Of course, this is during a bottom of interest rates. You have really low interest rates here. So it's saying that you have, basically expenses pretty high. You're getting poor returns on your bonds. That's not what you want to see for an insurance company. One of the big attractions for shareholders as an insurance company is that they have that investment component. But even when they were doing well, it's really dwarfed by these premiums and other fees that they're receiving. So it's just not a significant portion of the business, and it makes it a little less appealing to me as a potential shareholder. Now, what I do like is that they've bought back about 20% of the shares outstanding over the last decade. You started with 52 million. End with 39 million. So that means that you basically cut out that 20%. You add about 2% per year to your return by doing those buybacks. The problem is, of course, the unpredictability. You see 2012, you're at $15 EPS, and trailing 12 months, $13 EPS. Now, you have some years that are higher, like 2019 and 2021, but you're not having this steady growth. And the steadier the growth, the more reliable it is, the better it is for you to plan your own investment. Balance sheet. You can see that they've grown their securities by about 60%, 15 billion to 25 billion. Unearned premiums pretty low. You have, of course, you have the float. Any insurance company is going to have this really weird balance sheet to assess, and this is difficult to do in this format, but it's just something to be aware of. You're trying to check out, well, what are my securities like? How do they match up against my liabilities? You're matching up well against those liabilities, so that tends to be a good sign. But there's not a ton to take away here that we can't get from the other statements. You have stock-based compensation. I don't love that. It's not a huge amount relative to their cash flow, so that's okay. I mean, 30 million a year. Especially you could see buybacks every year. This is a really good sign. It's a great use of cash for an insurance company is to do those buybacks. If you're going to be a good investment in the insurance company over time, then buybacks are really good. They help you to really compound your returns. It's a good setup there. You can see that they're paying out strong dividends. They're not really having to fund this year by year with debt, so I like to see that as well. Having a lot of debt on an insurance company doesn't make a lot of sense because their whole business is liability based. So it makes sense that they're running at a net cash line. For me, though, that when I look at this company, what I really struggle with is this unpredictability. You see these cycles, and you have 1, 2, 3, 4, 5, maybe the start of a 6 cycle, but let's say 5 cycles in a decade. Once every 4 years, you're cycling through the business. That's quite a lot. And while that's okay, if these numbers bottom at 5%, then this business looks a lot better. But the fact that they're bottoming in the negatives is really poor. Now, if they only bottom like they did in 2020, that would be okay. But it's these losses that really hurt your long-term compounding. And that would be the reason that I would avoid it. It's also just a really difficult to understand industry, which would be another reason why it's not going to be on my watch list. But if you understand insurance, you probably know this company a lot better than I do anyway. So just keep that in mind. If you enjoyed this video, please hit that like button. Don't forget to subscribe and ring the bell so you get notified as I upload new videos each and every week. If you like this QuickFS.net software, the affiliate link that I have is the first link in the show notes below. And please use that link. That's a great way to support the show to sign up for a free or a paid account. Thank you for listening, and until next time, stop paying fees, start building wealth.